And for more on this, let's go to Jim Frischling, co-founder and president of New Oak Capital. So, Jim, let's just run the math here. We now think the Fed did not taper, even though Wall Street thought it would, in October because of all of this static coming up. Well, now that we're going to have another crisis by mid-January, a potential debt fault by early February, don't we get no Fed tightening until March at the earliest?
Easy money forever. No, it's not forever, but I will certainly say I agree with you. I think the general consensus is nothing between now and year end, and actually it could roll, certainly through the first quarter of 2014. We think the Fed had signaled tapering, then looked at the data, saw the economy being somewhat sluggish. But I think Chairman Bernanke actually saw the dysfunction in Washington, saw this battle coming. I think he has a pulse on this market and felt the Fed had to stand pat and actually keep these, keep the liquidity and the easy money coming. But now that we know in 90 days we're going to have the same fight again, I don't see why he would change course again between now and year end, and really between now and that agreement either being reached or not being reached, and you can expect it to be ugly again.
But even with this, deja vu all over again in 90 days and probably 90 days after that and so on and so forth, you got to be in this market because it is going up. Where do you see the S&P at the end of the year?
A little bit higher, but I think for those who believe, and we do, that the Fed is a major reason for the performance in the stock markets, and we're in that camp. We think with interest rates going to remain low, corporates continuing to just build their balance sheets but really strengthen these balance sheets, we think these companies will continue to perform. So yes, we think the market goes higher, but this can't last forever. And the fact is, the Fed's going to have to take the punch bowl away from the party. I hate to use that cliche, but it has to happen eventually.
I'm still saying Dow 16,000 by year end, I got to tell you. But I want to go after you guys on...
That's not much of a reach, by the way.
Yeah, not at all. Although it sure did seem like it was a big reach a week ago. But I want to go after you guys on all these estimates for how much this has hurt GDP growth. Because Mark Zandi came out from Moody's and said it's 1 week of government shutdown shaves a quarter point off of GDP growth. And now you're saying a full half a point has been lost by 2 weeks of government shutdown. Dude, that's like 25% of the growth of the entire country because government stays shut down for 2 weeks. What about the private economy? You're just way overestimating.
I think part of that is the consumer confidence, and part of that is how people are going to be reacting. And I think that's going to be tough to calculate for a period of time, because how are people positioning themselves? We now know what movie's coming at the start of the year. We actually think it could get uglier and a little bit even uglier. I think there was a consensus or a group in the government that actually wanted to see this thing go over the cliff. They didn't have the numbers, and I don't think that's where we're going to get to the next time. But we keep pushing the envelope a little further, and I do think it has businesses cooling off. I think investments are going to slow. I think the hiring is going to slow. All of that is, I think, what magnifies this issue.
Consumer sentiment was up.
Right, and I think we've been telling this story for so long. I actually think the consumer is fed up almost to the point where they're ignoring the government and they're getting on with their lives. And the numbers will get better because of that.
Well, you looked at Wall Street. They did not believe that Washington wouldn't find a last-second deal.
Bingo.
And the equity markets didn't flinch as a result.
Right.
So, again, and part of that is, if the Fed stays the course, this is a market to buy. The fact remains is, eventually the Fed does have to pull off, and the last time the Fed even signaled to pull off, the 10-year spiked to over 3%, mortgage rates rose, mortgage refinancings almost discontinued, and there was a concern that the economy itself was going to take a hit. So part of it is just really betting on the Fed, but for today, the Fed stays the course.
All right, thanks very much, Jim Frischling. Nicely done.